Spend any amount of time on financial websites or social media channels, and you will hear people explaining their stance on using debt. But what does debt actually do to you and your investments when it's utilized? Welcome to Strategy Saturday. I'm Charles Carillo, and today we're going to discuss why having too much debt might be your biggest risk. We'll explore why some of the most enduring businesses in history stay debt-free and what that means for us in today's fast-paced world. We'll also uncover how you can use this knowledge to protect your investment and ensure long-term success. Stick around because understanding the true impact of debt could change how you approach your finances forever. So let's get into it. I read dozens of blogs and websites every week, and a few months back, I came across an article on the Collaborative Fund blog written by Morgan Housel that I was instantly intrigued with. I have linked to the article in the notes for you to read as well, and I like reading his blog post because I find his point of view very practical and interesting. And this article on debt intrigued me since many people are over-leveraged in real estate, business, and life in general today. In his article, How I Think About Debt, Morgan explains that Japan has 140 businesses that are at least 500 years old, with some claiming to be more than 1,000 years old. It's astounding to think what these businesses have endured. Dozens of wars, emperors, earthquakes, tsunamis, depressions, and on endlessly. And they keep selling, generation after generation. Now just think that 80 years ago, in 1945, the country's economy and literally parts of the country itself were destroyed after World War II. And the Japanese GDP in 1945 was only 11% of the GDP of the United States, and the Japanese GDP in 1945 had experienced nearly an 80% decline since 1940. Now, add 420 years of events and issues out of the control of these Japanese businesses into the equation, and you realize how ultra durable these businesses truly are. The Japanese call them shinshi, and the one common trait is that they hold tons of cash and they have no debt. Now, Morgan breaks down this simple principle by noting that all businesses and people will experience volatility peaks and troughs during their lifetimes. The ability to weather these events, including recessions, divorce, illness, moves, natural disasters, income fluctuations, etc., is commonly determined by the person or the business's cash and debt position. As we pile on debt, the range of volatility that one can experience decreases. No, debt in general is not bad. It is a question of whether the level of debt is appropriate relative to the asset's value. What is the probability of the value and income fluctuations of the asset? The more stable an asset is, the more leverage that can be used. The riskier an investment is, the less leverage should be utilized. Problems usually arise when a risky asset is over-leveraged. And leverage works both ways. When an asset goes well, you make more money. But when an investment goes south, you lose more. Now, there's an old adage to never forget. The 6-foot-tall man who drowned crossing a river that was 5 feet deep on average. You need to make it through the low points of an investment or life, and the more debt you have, the less likely you are to do that. Morgan states, as debt increases, you narrow the range of outcomes you can endure in life. And a business or person with no debt and a cash reserve can weather nearly every storm. Suppose you are building a business now or a real estate portfolio and hope to live 20, 30, 40, or 50 more years from now. In that case, the chances that you'll have to deal with wars, recessions, health issues, family emergencies, health crises, career and income fluctuations are 100%, and most probably out of your control. So debt in any form narrows the survivability and outcomes of the asset or person it is pledged upon. And it's a fascinating read. I'm not a no-debt person, especially in real estate, but there is a time and place for it. And as you add more and more of it into your life, it starts constraining your options and your flexibility. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then. Have you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.